Right now, I'm just going to review different kinds of stocks and index funds and mutual funds, just very briefly. Okay, so the first thing we'll look at is stocks. Stocks are one of the easier concepts to understand. Um, Stocks are traded on the stock market. So some examples of stocks. Stock is like a part of a company, or we call them shares of stock. So some major companies we can think of are like Amazon, McDonald's, Shell, Microsoft, Apple. There's thousands of companies. So what happens is we take that company and we can divide it into smaller pieces. And then someone can buy a piece of that company. A good example is Amazon. Right now, you can buy one piece of Amazon stock. I believe it's like $3,000 for one piece of Amazon stock. Now you might say, well, that's a lot of money for that. It is. And the reason that Amazon is one of the richest companies is because not only is it $3,000 for one piece, but there are 14, I think 14.5 million shares or 14.7 million, something like that. So there are 14 million shares of this company. So if you buy one piece, you are getting one out of 14 million pieces. So if you add up all this money, if you multiply these two together, you get a whole bunch of money. And that's the value of the company. So this is stock. You basically buy the stock, and then as it goes through the day, the price will go up and down and up and down. Through the day, through the week, it goes up and down. And the goal when you buy the stock is to buy it when it's low, like let's say this is at $15. And then when it gets up here to like $17, you can sell that stock, and now you've made $2. So that's like the principle of stocks. Um, but of course, stocks take a lot of knowledge and a lot of time to do. So not everyone trades in stocks. You might know somebody who does. I know a couple people who do a little bit of stock trading, but really it takes a lot of time and effort to do. You can't just go out and start investing in stocks. I mean, you can, but you're going to lose your money pretty quickly unless you know what you're doing because the stock market goes up and down and up and down. So that brings us to our next thing. If I can't invest in stocks, how can I invest my money? Well, a little bit safer way is something called a mutual fund. Okay, so a mutual fund, what happens is it's a company and they take all the money from their customers and they start buying stock. So they buy stock from places like McDonald's and Target and Walmart and all these different companies. They just start buying that stock. So when I give them my money and you give them your money and your neighbor gives them money, they buy these stocks and they put it all like in a group fund. And then what happens is you get whatever return they get, but they're constantly trading. They are actively, we're going to talk about this a little later, actively investing your money. They're taking that money and selling and buying and buying and selling different stocks, but hundreds and hundreds of different times they're doing this. But they're doing that job for you. Now, as an investor, you can choose like a low risk mutual fund. So you can choose one that looks like it will be pretty steady, hopefully going up steadily. You can choose a high risk fund. And what happens is they'll probably buy something, but it might go a little bit bigger in terms of those swings than high and low. So it might look like you lose a lot of money over the course of a few months, or it might look like you gain a lot of money over the course of a few months. But you can kind of play it a little more like you would a stock, but not as dangerous. So this is kind of what mutual funds do. It allows us to invest without having to worry about playing the stock market. The next one we have is an index fund. Now, indexes are used to check, they basically check the heartbeat of the economy or the stock market. So think about it this way. If we want to check the heartbeat of Southwest High School, how would we do that? Well, maybe what we might do is just take 50 students from the high school, give them a test, or look at their grades or something and see how they're doing. Just 50 random students. So when we look at this, let's say we find out that all the students together, they average a B minus. Well, we'd probably say, looking at Southwest, Southwest is a B minus school based on the information we have from these 50 students. So what they use are indexes, and there's like the Dow Jones index and the S&P 500, and we also have like the NASDAQ. These you might have heard of on the news. These are some of the major indexes. There's a number of them. But like this, like an index, for example, might take all these companies, Disney, Walmart, Microsoft, all these companies together. And all they do is they look at the average for all of these companies. And it will tell them, if we look at the stock market, is the stock market going up or down based on these big companies? So what an index fund does, an index fund takes like those same 50 companies. So basically they invest your money in the same 50 companies that are on that index. So the Dow Jones has like 30. The S&P 500 has 500 companies. They'll take your money and invest in many of those companies. So if the stock market goes up or if that index increases, then yours will follow. It will be about the same in terms of the increase. However, there is one simple difference in that you see there's a difference here between these two. Well, this is because you also have to pay a fee. You have to pay for the privilege of them doing this job for you. You don't just get to keep all that money, so you pay a little bit of a fee. Now, this is where we get into passive and active investing. Active, of course, means action. You are doing something. And passive means you're kind of like, you're lazy, you're laying back, right? You're laid back and you're relaxing. So when we talk about active investing, this might be like in a mutual fund. A mutual fund, they're going to be actively investing your money. They're going to be buying and selling and selling and buying and selling again and again and again. So what happens when they buy and sell? Well, every time you buy and sell, there is a fee that goes with that. Now, the good news with active investing is that you can actually get much better returns because you're always buying and selling. And if the market changes a little bit, you're going to be able to react to it. Passive investing is much less buying and selling. It's like we buy it and sell it and we let it stay there for a while. Unless something goes really crazy, we let it stay there and we see what happens with the market. So many index funds will do something like this. They will be passively investing. Now, in the short term, an active investment will probably be a little bit better, but over the long term, it'll even out because you're not paying all these fees when you have a passive investment. You're not paying that extra money needed to pay for all these different buying and selling and all of that. So these are just some basic ideas related to the stock market and mutual funds and investment.